last few years, I've been fortunate enough to build up a double-digit property portfolio. During this period, I've had to develop my own knowledge and navigate through a whole host of challenges and mistakes. But the reality is, if I can do it, then so can you. This Property Market Investor Expert Series has been created so that you can learn from the mistakes which might otherwise be made along your journey, and open up your knowledge to identify investing opportunities which you may have otherwise not been aware of. Today I'll be meeting with Drew Evans, who when starting in property was able to build up a portfolio worth $5.17 million in just 5 years. Better still, the positive cash flow from his portfolio gave him the flexibility to start his own business, Core Food Property. So what is Drew's strategy? This is creating your own equity through small developments such as duplexes and triplexes. Let's find out from Drew more about his successful strategy. Hey Drew, how's it going?
Hey mate, good to see you.
So how did you get started in property then?
Mate, to be fair, Ryan, it was by default. I started off, I grew up in Zimbabwe in Africa. I moved to Australia back in 2001, went to university and didn't really know what I wanted to do. Studied business, so pretty much studied a degree in drinking, to be honest. Didn't get much work actually done. But then I started working for the National Australia Bank as a financial planner.
Yeah.
And
so sorry, this is back in Zimbabwe where you worked for?
No, I don't think Zimbabwe has financial planning. But, no, this is when I moved to Australia. So finished university. I always knew I wanted to get into the wealth creation sort of space.
Yeah.
So started working for the bank, and throughout that process, just thought it wasn't me.
Yeah.
So I actually went travelling, ran out of money, went travelling, ran out of money, went travelling, and then came back and worked for Newcastle's biggest house and land developer at the time.
Yeah.
Started really at the bottom, and to be honest, had no skills, no experience other than my financial planning background.
Yeah.
And so it was literally going around knocking on people's doors, probably one of the worst jobs you could do, but sort of found my niche in property and how I could actually make money.
Yeah.
So got promoted through the ranks there, and then after a little while found out it wasn't really for me.
Yeah.
In the fact that I got to know the inner workings of how land development worked and how people do the wrong things by clients.
Yeah, indeed.
So I quit that job, moved to Sydney, and sort of said, hey, applied with sort of 10 different companies. I know you're not employing, but this is what I do.
Yeah.
Got offered 5 interviews, got 5 interviews, got offered 3 jobs. And I actually took the lowest paying job at the time, and the reason I took that is because the owners of the business did some really awesome things. So outside the box, like the real estate, I mean, how you could genuinely make money. So started at the bottom there, then got promoted through the ranks.
Yeah.
Fast forward 5 years, and sort of the interest shifted away from helping out the client to helping out the business. So I'll leave that there. But during my time there, I actually met my business partner, Damien.
Yeah.
And we basically left that organisation, set up our own business, knowing that we could do it bigger and better than what we thought our competitors were doing.
And at what point during this journey with this property company did you start investing personally?
I actually started investing at the age of 20 I was.
Oh wow,
got my first property.
Started then.
Yeah. So literally worked 3 or 4 different jobs to save up my first bit of a deposit.
Yeah.
The developer who I was working for at the time used some of the commission, I guess you'd call it, he would get. I used that as my deposit.
Yeah.
So I kind of had a very different way of getting into the property market, but knowing what I know now, I'd never bought that property.
So what was that first property?
It was a 3-bedroom townhouse on the Central Coast in Lisaro. It was, in my opinion, overpriced, oversupplied. There's huge vacancy, but I actually used the first homeowners grant to move into it for 6 months. Then moved out of it.
I see.
And then
what was the purchase price?
It was $349,000. Which is crazy now, right? Because one of my biggest regrets is actually selling that property because it's more than doubled in value now.
How long after did you sell that one?
I sold it 24 months afterwards.
Oh wow. And
under
did
advice
you make
of my
much profit?
I didn't actually, mate. I broke even, so I got all my money back, but I used the money I got back to invest in another property.
I see.
Yeah.
So at that point in time, were you maybe limited by serviceability, so you had to sell, or did you not really understand at that point in time that you could do both, maybe?
Correct. At the time, I was really, wasn't serviceability because I was earning a decent income, it was more deposit funds.
Yeah.
So as opposed to getting the property revalued, getting equity out, which I didn't have at the time, I actually sold the property and moved it into another opportunity.
And what was that second opportunity?
The second opportunity was a house and land opportunity in Mudgee, the regional New South Wales. Again, another learning lesson. I can see you smiling. So
it's interesting, that.
I can assure you and all your listeners are a lot more experienced and have a lot more value now, knowing the mistakes that I made in the past.
Oh, for sure. Yeah, indeed. So what was the purchase price on the Mudgee property?
That was $445,000.
445. And what's that? Maybe a 4-bed, 2-bath?
4-bed, 2-bath. And I sold it for exactly the same price I purchased for it.
Ah, right. Okay. So kind of the same cycle again.
Same
Yeah.
cycle again. It was just pre the mining boom.
Yeah.
What I should have done is sold the property as soon as it completed. Would have
Yeah.
made $75,000-$80,000.
Oh, wow. Yeah.
But I kept it. And so made the same mistake, investing in other opportunities in Gunnedah. But this time, as my experience, my knowledge started to build.
Yeah.
As opposed to doing one dwelling, I did two with the
Yeah.
mutual lot subdivision. Again, I've still got one of those properties now.
So sorry, you purchased two at the same time?
I purchased a block of land. It was 2,000 square metres.
Oh, yeah.
And what I did is I built two 4-bedroom homes on
Yeah.
that particular parcel of land, and then carried out a subdivision. So essentially now I can sell one, keep one, sell both, or in fact keep both.
Now that's quite a progression, right? From buying
It
off
is.
the plan to now managing your own development.
Exactly.
It appears. Where did you find the education to be able to do that?
Well, that particular one, mate, to be honest, was all trial and error. I did it myself.
Yeah.
I've always been a big believer in getting educated and learning from other people.
Yeah.
So at the time, I definitely was not the guru. I learned a whole lot of things about what not to do in development, which obviously has led to me what I'm doing quite well now.
Yeah.
But for that, it was small things like, the surrounding blocks were 650 square metres. In my head, I thought, hey, very easy to subdivide given mine's 2,000 square
Yeah.
metres. It turned out I couldn't actually do a Torrance-style subdivision. I had to do a strata-style subdivision.
On two houses.
On two houses, correct.
In 1,000
square metres
why is
each.
that? Is that just the zoning?
It's the zoning because the lot had already been subdivided.
Yeah.
It was a farmer's cow paddock previously,
Yeah.
down to 2,000 square metres. The laws under the LEP
Yeah.
didn't let you subdivide it even further
So
down.
this is another learning curve for you, I suppose.
Massive learning
so
curve.
you were potentially
Yeah.
were you already in council when that arose.
Correct. I'd already settled, I'd already done.
Yeah.
The other learning lesson there was I didn't do soil tests before going unconditional.
Yeah.
In Gunnedah, it's very much reactive clay, it's black soil.
Yeah.
So it's very expensive to get foundations down. So
Okay,
I had
yeah,
to spend
wow.
another $15,000 in screw piers, concrete
Yeah.
piers, which I didn't budget my feasibility. So another thing that I kind of learned through the process.
And this was all funded through the sale of your second property?
No, at the time I had my Mudgee property, and this is done through savings.
Oh,
which,
savings as well. Okay. Yeah.
Well, that's one of the hardest parts, mate, to be honest. This has been my biggest learning lesson
Yeah.
is, for every dollar that you save, essentially you've had to earn it twice.
Yeah.
Because you've got to pay tax, you've got to pay living expenses if you've got a family.
Yeah, indeed.
And for me, that was the hardest part, and this is what I teach all my clients now.
Yeah.
Is you really want to invest in property that's going to set you up, it's not
Yeah.
going to set you back. And
Yeah.
the hardest part, in my opinion, is getting your first 1 or 2 properties because you have to save the money for the deposit. Or you can do joint venture agreements or speak to your parents and things like that. But if you don't have those options, for me, getting your first 1 or 2 is extremely important.
What was the total development cost for this project then? So you've obviously purchased a large block of land, and then there's the construction costs and council costs.
Yeah.
Approximately how much did you
Mate,
spend?
it was
in total?
probably about 800 to 850,000.
Yeah,
for the
okay.
total
And
project.
was there was a few learning curves, it sounds
Yeah.
like, throughout
Yeah,
that
yeah,
process,
there
which
was.
is all vital today, I imagine,
Yeah, it is.
really. Yeah.
Yeah.
So what was the end realised value?
Mate, it was about $1 million.
Okay, yeah, so there
that's
was equity in there.
There's definitely equity in there, but it's still again a bit of a learning curve now.
Yeah.
Knowing what I know, would I have spent 800 grand to do it?
Yeah.
Heck no. Would I even got into the market to start with? Probably not.
Yeah.
But in saying that now, it's producing really good cash flow, positive cash flow, so it's not costing me any money to hold.
Yeah.
But given the downturn in the mining markets, it's not the most liquid market. So
Indeed.
having my time again, I probably would have dumped that 800 grand or $1 million into Western Sydney.
Oh, for
bought
sure.
absolute rundown properties, and we probably wouldn't be having this conversation today.
So it was it immediately after the development completed that you sold one of the two dwellings?
No, I didn't. I actually kept them and rented them out.
Yeah.
Again, which was another mistake I made.
Yeah.
Knowing what I know now,
Yeah.
should have completed the development, sold it off straight away, taken that cash, and then moved on to the next development.
I see. Okay, and that's
Yeah.
because there was no point retaining that particular asset because there wasn't maybe the foundations in place for capital growth, the fundamentals.
Exactly. Exactly. Mate, the consumer confidence went out of the marketplace. The
Yeah.
population growth wasn't there. The rental yields were strong, but essentially, knowing what I know now, there's
Yeah.
much better markets to get a better return as opposed to holding that piece of real estate.
For sure.
Yeah.
Indeed. So you kept hold of that, and for the first time, you could actually refinance and pull out equity.
Correct. Correct.
What was the next move?
So that was kind of my aha moment, sort of thinking,
Yeah.
hey, listen, don't buy normal traditional real estate where
Yeah,
you're
yeah.
paying somebody else's capital growth. There's huge amounts of margin. Working with developers and builders and people like that.
Yeah.
The aha for me was thinking, hey, I think at the time I picked up the BOW Rich List, and in that magazine, 51 out of the 200 people in there had made all their money through property. So I was like, well, hey, I'm starting to
indeed.
learn the ropes, and that's kind of what my aspiration is now, is to use
Yeah.
property development as a tool to sort of build my wealth.
Yeah.
So the next thing from there, I actually purchased a corner block in Newcastle. It was 225,000 was the land. The land size was 765 square metres.
Yeah, wow.
Right? Now, I tell you, the reason I tell you this is because understanding the town plan and the zoning laws shows you how you can maximise, a building pattern, the density.
Yeah.
So the laws were you had to have a minimum lot size of 800 square metres in order to carry out a Torrens title subdivision.
Yeah.
That's the law,
Yeah.
right, which I found out afterwards. Fortunately for me, it says if there's an existing dwelling on the property, the minimum lot size is 350 square metres.
Okay.
So what I did is I went to architects and I got specifically designed 4-bedroom homes, put the 4-bedroom homes on there,
Yeah.
then went to the council to carry out the subdivision
Oh, so you did it in 2 stages.
in 2 stages. Do the reverse way around. Because
Interesting.
if I tried to subdivide first, it didn't comply with the zoning laws, right?
Oh, wow.
Built the 2 4-bedroom dwellings,
Yeah.
then carried out the subdivision.
And what sort of, it's a very interesting point because I suppose a lot of people may go into this themselves and not really understand the difference between a strata or a Torrens titling for the actual subdivision.
Sure.
So what sort of difference in value are you looking at between a strata and a Torrens?
Mate, it's a hard question to answer because it really depends on who's going to buy it and how much of an issue they see that. If you've got a duplex, for example, or even what I've done in the past, 2 4-bedroom homes, the strata really isn't much, right? Maybe it's a common driveway or, so it's really negligible. But at the end of the day, it just comes down to the concern of the person that's going to buy it off you.
Yeah, indeed.
It's not like you're buying into a big unit complex where you've got lifts and swimming pools and gyms and saunas where your body corporate's at $2.5, $3.5 grand a quarter. It's not like that at all. You'd be likely to spend $1,000 for the entire year.
Yeah.
But for me, my preference is always to get Torrens title because essentially you don't have to worry about the CMA at all.
Indeed. And have you come across a community title in the past?
Community title, yeah, it's a CMS for sure.
And where does that sit in the? I suppose if we're looking for an ideal scenario, would that be below strata? Or?
I'd say it's probably on the same level, mate. But for me, it's always to aim for Torrens title subdivision because you have that flexibility. You don't have to get permission from a body corporate. You don't have to have AGMs and things like that.
And when you're looking at land for potential development, you're looking to get that Torrens title from the offset.
If you can, mate, but sometimes, as I said, if you can only get a strata title subdivision, mate, still, as soon as you can add value on something, it gives it this intrinsic value. It's still beneficial to do that.
I see. Yeah. And how do I go about? So I imagine that part of the process is putting together a feasibility.
Yep.
And you're looking at comparable sales in the area.
Yeah, spot on.
What if, for example, I'm looking at an area and there isn't a precedent, so there's no existing, let's say we've got, like your example, we've got a 700 square metre block, we want to build a duplex on there, but there's no existing duplexes within the suburbs. How would I go about looking at comparables to complete my FISO?
That's a very, very good question. It's something that we not struggle with a lot, but it's a challenge we come up against a lot. Because what we sort of pride my business on is being able to get in first and sort of set the precedents. Now, with that, there's 2 challenges. First of all is how much is a decent amount to pay for your land acquisition, for your construction cost. And then the second biggest challenge is your bank valuations. Because remember, in order for you to get finance, unless you're lucky enough to pay cash for a property, you have to keep the banks happy. The first thing that banks do is they look for comparable sales through RP data. If there haven't been those comparable sales, as opposed to valuing a 4-bed, 2-bath, 1-car duplex half, which is what they should do, they may value it as an 8-bedroom house, right? Because they don't factor in your Section 94 contributions, your headworks charges, your subdivision fees. And if there's no 8-bedroom houses in the area, guess what they do to your valuation?
Yeah, indeed, they bring it down. Correct. So it could be the case maybe that on the construction loan, your valuation is lower, which means that you can maybe lend a lower amount. But upon the actual strata or Torrens title being completed, that's when the value increases.
Exactly.
And then you could potentially refinance and access the
100%. So I'll give you an example, maybe easier for your listeners to understand. So we've got a duplex opportunity in Goulburn at the moment. Right? The acquisition cost is $860,000 for an 8-bedroom, 4-bathroom, double-cup garage home, which has the ability to be Torrens title subdivided. Now the challenge is in Goulburn, because we're in stage 1 of a release, which is the favourite stage I love to get in. Because as you know, developers, as they release more stages, the land gets more and more expensive, right?
And why is that? Because just the capital growth of the area is taking effect?
Correct, because developers are no different to you and I in the fact that they love to make mechanical momentum through their master plan developments. So the biggest misconception is that developers launch 200 lots all at once. They don't do that, right? They launch 20, sell those out. Increase the price, they'll launch the next 20.
And will that help with their own financing requirements?
Definitely. If you think about it, like if they put the land price up by $10,000 or $20,000 a block, what have they had to do for that extra 10 or 20 grand?
Yeah, indeed.
But it's a way that they like to make profits, report to their shareholders. So in that Goulburn example, essentially, before you can go ahead and actually transact in the property, is you need to get the finance approved by the bank. Because we're in stage 1, there's no comparable sales. right? So what they've been doing, the valuers, is they're saying, hey, we can't focus on your Section 94 contributions, even though sometimes those are in excess of $50,000 for the fees.
Yeah.
We can't see that.
Yeah.
They also look and say, well, listen, there's only 8-bedroom houses in the area. There's no duplex halves. So in some cases, you can get valuations up to $75,000 less than what you're paying for it, purely because there's no comparable sales.
Indeed. So I suppose that if I'm looking at an opportunity like that,
Yeah.
I may need to maybe account for a shortfall in my cash.
Potentially.
Yeah,
I mean, part of
yeah.
what we do before we take on a project like
Yeah.
that is I don't want to say wine and dine valuers, that's the wrong term,
Yeah.
but we definitely go to see how they would value a project before we take it on.
I see. Okay,
Yeah.
so you mitigate some of that risk and the
Big time.
uncertainty.
Yeah, because at the end of the day, mate, we can have the most amazing project. If you
Yeah.
can't get the finance, what's the point?
Yeah, indeed.
Right? Unless you're lucky enough to pay cash for it, which some of our clients do.
Yeah. So it sounds as though in your personal investing journey, you kind of crystallise this strategy.
Yeah.
And if you were to articulate where you feel your expertise lies,
Sure.
and what you're really specialised in now, would that be duplex development?
I wouldn't say duplex development. I'd say anything where you can add value through
Yeah.
using property development.
Okay.
So
Yeah.
for us, it's all about finding opportunities that are under market value, then having the ability to add value. So
Yeah.
at the end of that, you can either sell or refinance to keep growing and moving your money forward.
I see. Yeah.
One of the biggest challenges, Ryan, is people when they first get into investing don't understand the basic investments of how finance works.
Yeah.
From a very high level perspective, there's only two things that will prevent you from growing your portfolio. It's your borrowing capacity or it's your buying power.
Yeah.
And as long as you can keep those two things in check, the bank should be happy to continue to lend you more money.
Do you think that, the last few years have been quite challenging from a finance perspective,
Yeah.
right?
Yeah.
If somebody may have been able to grow their portfolio during that time,
Yep.
and as long as they've got a well thought out strategy with an advisor like yourself and also
Sure.
with a finance broker,
Yep.
that if they get that balance of acquiring better yielding properties
Yep.
and then creating equity and kind of playing that level of, I suppose it's like chess, right?
Sure.
Strategically
Yep.
choosing your moves ahead of time,
Yeah.
that you can always continue to buy property?
I think that philosophy, and I'm not a finance expert, I've obviously got a team of people that do that
Yeah.
for me, but I think that's a strategy of the past, and the fact that banks now are becoming so tight
Yeah.
with the way that they lend you money. So essentially you can't become too rent reliant,
Yeah.
otherwise the banks won't continue to do it. So
Yeah.
that's why I love this strategy that I employ, because at the end of doing a development, you have the option. Do you sell one? Do you keep one?
Yeah.
Do you sell both or do you keep both?
Yeah.
And for me, it's really easy. In order to keep up your borrowing capacity, you need to do one of two things. Increase your income,
Yeah.
sometimes easier said than done, or decrease your debt, right?
It's an interesting thought. Some of the success stories that I've seen, and no
Yeah.
doubt you've seen over the last maybe 10 years, real successful investors that have built up property portfolios of 20 plus 30, 50, 100 plus properties.
Sure.
And, that was in a different time to today, unfortunately,
Yeah.
because I would have loved growing up in that environment of
Me
just
too.
acquiring low-dot loans, 105% lends. I
Yeah.
mean, that's absolutely an amazing opportunity for people, but unfortunately it might not be the case now.
Yeah.
So do you think that potentially you do need to apply a strategy of almost less is more as long as the LVR is lower?
Kind of. I think you need to employ a strategy of whatever you're going to buy is going to set you up or is going to set you back.
Yeah.
I think the days of buying cheap property that have a small positive cash flow, buy as many of them as you can.
Yeah.
Sounds good in theory, right? If you're in
Yeah.
a good, strong growth market and the banks will continue to lend you money. I think one of the challenges that we have is the banks won't continue to lend you money unless
Yeah.
you pay down some debt or you increase your income. So for me, yes, less is more, but it's all about the result. What's going to create for
indeed.
you? And I always get asked, Drew, should I sell? And my response is, hey, never ever sell unless it prevents you from doing something else.
Yeah.
Or if the opportunity cost of holding that asset outweighs the opportunity cost of selling it.
Yeah.
Right? Because at the end of the day, you've got to say, well, listen, in my current portfolio, can this opportunity make me 100, 150, 200 grand in the next 12 to 18 months?
Yeah.
And if the answer is no, well, then it's definitely worth considering taking profit off the table,
Yep.
paying down some debt, and redeploying that capital to keep growing.
Yeah, indeed. When you're speaking with clients or potential clients, what makes somebody successful? What sort of things are they doing differently when you're looking at the
Yeah.
real success stories that you've come across?
I mean, that's a hard question because everybody's different that I work with. But as a general rule of thumb, successful people know how to get their money to work hard for them.
Yeah.
They're not working hard for their money.
Yeah.
A lot of people that I work with are so good at their job. They're high net worth individuals. They earn lots of money, but they know that they need a team around them that knows more than they do in specific areas of development.
Yeah.
So for them, it's having the ability to outsource to the right people.
Yeah.
It's the ability to learn what's holding them back. It's understanding what financial inefficiencies they may have in their personal life and in their portfolio.
Yeah.
And then building a strategy that's going to set them up, not set them back, in line with their goals.
Yeah, indeed. Okay. And
Yeah.
when you work with clients, do you have a team that they can potentially leverage? You know, like an accountant, a finance broker, a solicitor, etc.
Yeah, we do. I'm a big believer of jack of all trades, master of none.
Yeah.
So people sort of ask me about property management as an example, and
Yeah.
nothing against property managers, but I couldn't think of anything worse.
Yeah.
So, hey, Mr. and Mrs. Client, don't speak to me. Have a chat to so and so, and they can help you out.
Yeah.
The same thing when it comes to law. Like, law is so important, right? When you're doing property development or any property investment, it's not like you're popping out to the pub and you're shouting your mates a few schooners. It's a big deal, so it's really important that you protect yourself. I'm not the guy that specialises in property law. Speak to somebody who is. He has a contact.
Yeah, indeed.
Yeah.
Throughout your personal investing journey, have you been comfortable leveraging LMI? So maybe getting a higher LVR ratio?
Very good question. Yeah, I am. Not now because I'm in a position where I don't need to without sounding arrogant. But when I first started, every investment I did had elements of LMI.
Yeah.
The reason being is it's so hard to save money. Given today's society. So I used LMI on every property. Because it allowed me to get into the next development sooner.
Yeah.
Yes, I had to pay mortgage insurance.
Yeah.
But I was fully employed working for somebody else, so it was all tax deductible.
Yeah.
So I'm a big believer of using LMI if you do it in the right way. But in the same respect, you definitely shouldn't bite off more than you can chew and put yourself under any financial strain.
Yeah, indeed. And how important would you say is then maybe getting a depreciation schedule to your particular strategy?
It depends on what you're going to do with it. Right?
Okay.
And this is a very good question because if your intention is to buy, develop and sell straight away, there's no point spending the $500-700 on a schedule. But if your intention is to keep the property, then you definitely should be doing it. There's huge tax advantages to this strategy. If you think about a duplex, you've got 4 bathrooms, not 2.
Yeah.
You've got two kitchens, not 1.
Yeah.
Right. So the depreciation that you can get is a lot more than in your traditional dwelling.
Yeah, indeed. Okay. And, if potentially it's a strategy that you can build upon, maybe it's realistic within 10 years to stop paying income tax.
Yeah, definitely.
Yeah.
Depending on the entity that you're doing it in. I'm a believer if you're paying tax, it's a good thing, but you need to minimise how much tax that you pay.
Oh, for sure. Yeah.
So I guess a lot of clients that I work with, the high income individuals, are paying a fortune.
Yeah.
And I've got to be very clear, tax minimisation is a benefit for what we do, not a reason for doing what we do.
Yeah, indeed. And as you build out your portfolio and the people that you work with, as you see them build out their own portfolio, I suppose that you get to a stage whereby, I need to kind of establish some internal operating procedures for myself because now I've got, say, a property portfolio of 5, 10 plus properties. I can't just respond to emails. I need to maybe set up an Excel structure for actually putting in my income and expenses and making sure that the rental income is actually arriving in my bank account. Is that something that you kind of learned along the way, or how did you go about kind of establishing a process for that?
Sorry, as in relation to how I manage my cash flow of my portfolio?
Yeah, indeed. So how you manage your portfolio now that you've got a portfolio?
Yeah, mate, extremely important because the money flow of how all the rents come in, how the tax deductions come in, now that I have my own principal place of residence, my own mortgage, extremely important. So I basically have an offset account against my own home. And we're discussing before this interview, my goal is to be completely debt-free in my own home by the end of next year, which is kind of cool. So
over what time frame, sorry?
End of next year.
Oh, fantastic. So you're almost there.
Yeah, so I was doing a similar strategy to you, where I was living in Sydney, rent investing, living where you want to live, renting where you want to live, and investing where you can make cash. I've been pretty fortunate to make close to $2 million in the last 5 years. I took the plunge and dropped a knee with my fiance. She said, "Hey, time to buy a house." So the buying power of what we could get on Lake Macquarie versus what we could in Sydney is phenomenal.
Oh, without doubt. Yeah. So did you put down a sizable deposit to maybe help with financing as well?
Big time. Yeah. So I was lucky enough to buy my dream home on the water. So 6-bedroom, absolute waterfront house, own boat shed, own jetty.
And you don't have kids yet, do you?
Not yet, mate. Not yet. So maybe I have to get a few more developments to afford them. But no, the point I was getting at there is your finance structure is so important, especially as you grow your portfolio, to make sure that money's going in the right directions and you're helping to pay down your non-deductible debt and making sure things aren't getting lost, because it does get quite tricky having income coming from everywhere, expenses coming from everywhere.
Okay, so has your progression been along the lines of you've made some mistakes, you've learned from those mistakes, you've crystallised a strategy, you've created a foundation portfolio off the back of that. Then you've moved to the period in your life whereby you're wanting to purchase a principal place of residence. So you've done some chunk deals, you've built up your cash asset base, and then you've actually put down a sizable deposit, and now you're actually paying down the final bits of that principal place of residence. And then what's next?
Well, mate, it's a good thing, and I'm glad you started off with mistakes because I'm a pretty genuine and honest
Yeah.
guy. I've really made some mistakes, but
Yeah.
the key is I've learned massive amounts from making those mistakes
Yeah,
to
too
ensure
right.
that people
Yeah.
don't make the same mistakes I made. I've really found my niche now in property development, and sure, it's only smaller development,
Yeah.
but it's getting amazing results. You know,
Yeah.
it's kind of harsh to say if you're not involved in it, but the harder and harder it gets for everyone else, the easier and easier it gets for us
Yeah.
in relation to getting results. So
Yeah, indeed.
for me personally, all of my opportunities aren't necessarily to buy, develop and sell. Some of them I'm to buy, develop and keep because I believe that the market maturity that they're going to receive is going to be more beneficial than taking small chunks of profit off the table as we go.
Yeah, okay. And do you think that you'll ever sell down your portfolio to reduce all the debt and
Yeah.
potentially just have a no loans whatsoever remaining on your portfolio?
Well, that's the goal, mate. When you hang up the
Yeah.
boots, when you're growing old and got less hair,
Yeah.
is essentially retiring your portfolio.
Yeah.
I'm pretty fortunate now that the rental income that comes from my portfolio is about 265 grand a year in rent.
Ah, yeah. Yeah.
I don't own it all. The banks have
Of
a healthy
course,
chunk,
yeah,
but
yeah.
it's left with a net cash of over 100 grand.
Fantastic.
yeah,
So that's passive income for you now. Yeah,
if I wanted to, yeah.
Okay, lovely
Yeah,
stuff.
but again, my goal isn't to stop at $100,000. It's to obviously
Yeah.
get bigger and bigger. And to be honest, mate, I absolutely love what I do, so I don't really consider it work.
Yeah.
So,
It's tough, right? I mean, I've been speaking with a few people, and it's quite addictive. Let's
It is.
purchasing property, so
It
to
is.
hang up your boots, so to say, it's going to be tough to actually hang up indefinitely and not get tempted back into the market.
it's hard when you first start, right? It's because
Yeah.
it takes so much time. You get all these amazing ideas and you get really
Yeah.
excited. But the challenge with property development is it just takes time to build up the momentum.
Yeah, okay.
And I think that's key. In fact, I listened to a speech from Donald Trump the other day.
Ah, yeah.
He's talking about how important momentum is. And
Yeah.
once you've got it, because it's tough to get started, it's really, really tough.
Yeah.
But if you understand how your finance works and how you can get money to work harder for you, it does become really, really fun.
Yeah, great.
Yeah.
So if somebody wants to reach out to you and learn more about your strategy and potentially how they can leverage your experience,
Yeah.
how should they go about that?
Awesome, would love that opportunity, mate. So if you just go to www.kaifu.property,
Yep.
CAIFU property.com.au, all of our information's there, and we'd love the opportunity to chat.
Lovely stuff. All right, well, thanks a lot for coming in, Drew.
Awesome, thanks so much, Ryan. Cheers, mate.
Take care.
Cool.